Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to look at Twitter, see what people are sharing on social media, like we normally do in the mornings. I'm going to interject my financial opinions as we go, generally related to three different topics: wealth building, financial topics, and or commodities. So let's dive in there. Let's see what people are talking about, and I'll share my opinions as we go. You want to follow me at funny_finance. And if you want to join our community, finding-value.com, that's where we go over individual companies, individual sectors. I do trainings. I really share my opinions a lot more freely than what I do on YouTube. And you can get the inside on exactly what I'm doing, what I'm buying. And we're mainly buying stuff that is down, that is inflecting upward. Stage one to stage two in stage analysis, we see some of those types of movements. All right, so we've got Logan. Logan put up George Gammon versus Logan Mahatma, however you say his name. There was a debate. I watched a little bit of it. I guess I just have a different view than the majority of people. Um, Logan, I think he's got real good data. I think he's right. George has different opinions. I'm kind of in the middle where I might look at things a little bit different. So I want to go over those differences real quick because the housing market is a cornerstone of the economy and where credit is created. It is extremely important to get this part of the market correct. If there is a housing bubble, we would see the markets really pull back with a credit deleveraging event possible, or the markets would pull back from unemployment, from reduced construction, all that stuff. So it's real important to understand recessions are generally following a housing market slowdown. I think every housing market slowdown has ended in a recession. Not all recessions are led by housing market crashes, but every housing market crash has ended in a recession. That makes sense. Um, Here's one thing that the finance guys I think have wrong. Um, George was continually trying to say that a recession is going to bring the housing market down. That is not what we've seen in history. Generally, recessions do not occur if you are going up in housing starts. Now, I'm not stating that we will go up in housing starts. I am just stating that when housing starts go up, we do not have recessions. And when you look at history, we've never had housing starts go up and had a recession at the same time. We've had market pauses in the middle, but they were mainly driven by an overbuilding of real estate, or the housing starts went down due to too much inventory. Now, are we in a weird situation where we can get a bubble with a recession and with home prices to go down? I don't think that is possible, because if you get a recession and interest rates pull back, you're going to pull back into a very large demographic wanting to buy homes, which will then feed more demand because the affordability is going to go right into a gigantic demographic wanting to buy homes, and you just unlock the affordability for that. So, a lot of his examples that he was giving, I don't know if they hold water, because he'd be like, well, if inventory went up, we'd go and, it would, house prices would crash, and we go into this recession. It's like, you can't have all of that in one time. Like, he's giving a scenario that might not be a possibility. The reason that inventory is going up is because affordability is bad. You can't use that in the opposite direction, though. You can't say if affordability gets better, that all of a sudden inventory is going to continue to go up. So the reason uh, the reason inventory is going up is because of affordability, but it may not bring house prices down as much as what he thinks. And if house prices start to go down, more than likely they're going to lower the interest rate, which then brings on more affordability, and more buyers to the market are going to come to the plate. So the affordability is the teeter-totter that we are basically teeter-tottering on to control the supply-demand balance in the housing market. And when affordability gets better, you're going to bring on more buyers because the buyers are there. In history, that hasn't been the case. We've generally had a weakness in the housing market. We built too many homes. We had forced selling, which then caused the recession, not the recession causing the housing market. He has it backwards. The housing market is what's driving the recession in 90 something percent of the cases. So you can't really work the other way around. It's the supply and demand of homes that is driving all this. There's my opinion on it. The total monetary base has increased by nearly 10% year over year. Look at that monetary base increase. And you know what we're seeing? We're starting to see commodities start to strengthen up a little bit. So that's a good thing, I guess, if you're a commodity investor. Billionaire Eric Sprott thinks gold can go to 8,000 and silver to 200. And the comment I want to make here is I think he's exactly right. I think it can even go beyond that. And it's the conditions that are going to drive it up there. So, what conditions are going to come to drive gold and silver to those levels? I think that we are going to squeeze energy a few years out. We're going to get very high energy prices. And under that type of condition, I think gold and silver are going to follow it higher. We could even see interest rates go up quite a bit. So that's my outlook over a 5 year, 10-year period going forward. I think we're going to squeeze energy, and I think gold and silver are going to hit it much like the 1970s. They'll be very similar to the 1970s, but the 1970s was only in America. This is going to be worldwide. And I don't even know if 8,000 is high enough if this condition does occur. I'm not saying it's 100% in the bag, but I do think that something like that could occur. Another one, and he said 95,000 USD. This is for Frontline and OET. Occidental, the charter Occidental, what we're seeing here is the USD day rate is $95,000 per day at 72 days. That is crazy for tankers. 92,000, he has 95. Was it 95 or 92? Yeah, it was 95,000. $95,000 day rate. Wow. Coming back, not rate cuts, but rate hikes? Question mark. Uh, what this is from is the Fed minutes. It says, over time, I remain willing to raise the federal funds rate at a future meeting should the incoming data indicate that progress on inflation has stalled or reversed. Restoring price stability is essential for achieving maximum employment and stable prices over the longer run. Maybe rate cuts aren't in the future, and maybe that's what gold and silver are not moving higher, is because maybe rates are going to go up in the future, and that's why they're paused, moving sideways. We've got OPEC. So OPEC Plus will consider extending voluntary oil output cuts into the second quarter. 3 OPEC Plus sources told Reuters, to provide additional support for the market and could keep them in place until the end of the year, according to 2 of them. Someone has brought up in some of their readings that they might think that OPEC is basically rolling over and that these cutbacks are, I mean, they might have a little bit more production, but they may not have as much spare capacity as what the world thinks. And that's what some of these people are speculating on. And maybe that's the case. Calvin says, I keep telling people to review the 1970s. Energy and metals were the only thing to own. And this is now JP Morgan is warning about stagflation. He is right. If we get an energy squeeze, energy and metals are the spots to be. Everything else is going to be pretty rough. So JP Morgan warns investors should brace for a 1970 style stagflation. And I do think something like that could occur. Here is March CAPE. So this is the CAPE rates. With big reversal today, after opening slightly weaker, we are now plus $2,300 on the day and nearly undoing all of yesterday's weakness. There we are, ripping to the upside. I know coal's looking pretty good, and a lot of coal gets shipped. So maybe that's contributing to some of these dry bulk rates. So dry bulk, Capesize up 4%, Panamax up 2%, while the tankers are flat, is what we're seeing. And obviously, with Saudi Arabia holding the cuts for oil, we're not going to be shipping as much. So even though the tankers are very expensive at the moment, we're not really squeezing with the worldwide production as much as we can produce and ship. So that's also some upside there that could be left in the tanker market. Eric Nuttall says oil market false narrative number one, demand is weak, and you can see that we have higher demand than any times over the past few years. We are at record all-time high demand for this part of the month, this part of the year, I should say. Christine says, noteworthy that nearly all Permian operators are producing less oil per well per equivalent sized lateral year over year. Shale production is getting gassier and gassier, which generally occurs towards the end of production. So as these wells age and you go after lower and lower well quality, they tend to get gassier. They're getting older. So that's the Midland Basin oil productivity. There we've got it. And then we've got the Delaware Basin productivity as well. And what this is I think, okay, these are the wells going across here. We've got this, and I think gas here, the 300-month EUR MBO divided by 1,000. So the average is 50, and this one here is the average is 69 million barrels of oil per 1,000 lateral. So they're losing their oil. Is it going to be like this? How many people think that it will be like this? By my math, not many. What does the world look like if this line is going up and all those people are wrong? How will that impact our portfolios? These are the questions I'm asking myself right now. Well, I'm already positioned in crude oil, and I think crude oil is going to outperform the S&P 500. What is that going to mean, and what's the impact for the portfolios? It means higher interest rates. It means that money's going to rotate from those other sectors into crude oil and crude oil equities and energy service and a lot of the energy sectors, and potentially even precious metals eventually. And we can see that through his analysis here. It's coming on up, and the momentum's going to go where crude oil could outperform S&P. It makes no sense. It makes me so furious to bump into yet another mega Twitter YouTube guy with a tagline about helping you build wealth, and then see this image in the header, housing bubble 2.0. And that's where that debate between Logan and George originated from. But I agree. I don't think we're in a housing bubble. We don't have the inventory to create this gigantic bubble. We don't have the forced selling. None of that stuff exists. So what I think is occurring is that he's trying to tie macro financial picture stuff into the housing market, but really the housing market is what's driving the macro fundamentals. He has it backwards, in my opinion. So Gary says, I tried to warn people that uranium was becoming dangerous. It was stretched too far above the 200-day moving average. The forces of regression didn't apply to uranium. And I love the response by Patrick here. He says, you're so right, Gary. That huge supply deficit vanished when equities went above the RSI into oversold territory. Thank you, Gary. I just think that's absolutely great. Great comment, Patrick. I'm a hybrid investor. I don't use the charts solely. And yes, things can get overdone, but I'm just going to stick with it, ride it for the long term until the fundamentals, until the supply deficit really gets solved. And I don't think that's going to get solved anytime soon. So I don't need to be trying to time the market of timing a top and buying a bottom. I just ride the thing. Just ride it. That's what I'm doing. Steven says global LNG demand will rise 50% by 2033, says Australia's top producer. This is pretty bullish. Shell sees 50% increase by 2040. Asian demand expected to rapidly rise. Lower prices these next few years will increase imports into the emerging world. So LNG demand is going up, but also the supply and the terminals coming online later this year is going to have a lot of takeaway capacity for America. I should say North America. Canada, I think, has got one coming in too. So I think prices are going to go up in North America, and I think prices could be a little bit lower on the world pricing, and we'll meet somewhere in the middle. Here's so gold and silver. Gold is still holding the blue breakout plus 2000 level. Silver is sitting right below its blue breakout resistance line. So there's that blue breakout resistance line. We're right below it, ready to go and break out. Silver quarterly. We've got the 2650 level that he's got there. And then the breakout's already occurred in gold. And we're sitting on top of all this support for the gold quarterly chart. Yes, these are going to go way up. And I think that the catalyst is going to be high energy prices. It's going to be like a 1970s type move. So that's my opinion there. What are you looking at? Oh, just India tripling its natural gas use. Tripling. So industry to drive tripling of natural gas consumption in India by 2050. This is going to be one of the big drivers of demand growth. So this is your annual natural gas consumption in India by sector. You can see where we're at right around 2022, 2025, and then we just ramp it up dramatically. Do we have enough natural gas in North America to provide all of this LNG exportable capacity? I don't know. I mean, obviously, the Middle East is going to be helping provide energy as well, but we are putting in a large amount of LNG shipping capacity. And I'm curious to see if we can provide that much natural gas. I mean, it's a big increase from where we are today. Natural gas provides most 62% of the energy delivered from all US fuels and sources during January's winter storm. So when we had that winter storm, natural gas provided 62% of the energy delivered. So this is during the brutal Arctic blast. Natural gas provided 62% of all energy delivered in the United States. So we've got petroleum, nuclear, electric power, coal, solar, wind, and then we've got 62% of natural gas. And I'm sure that's used for electricity generation and heating homes. Natural gas is the single largest source of energy used to generate electricity in the United States, making up 43% of electricity generation in 2023. So natural gas has grown the fastest of any source in terms of total capacity. Now, on a percentage basis, solar is growing very fast on a percentage basis of year over year growth, but natural gas has taken the lion's share away from coal in terms of total generating capacity. Nice chart. Here it is over the last 10 years with the price of natural gas overlaid. So we're looking at excess reserves. You can see as we go to excess reserves, the price of natural gas goes down. As we draw on those excess reserves, you can see the natural gas price go up. So we've got this nice relationship and this cycle going from negative excess reserves to positive, to negative, to positive, to negative. But one thing to notice is we are going from further extremes and tightening this up. The extremes aren't as much anymore, not like over here. but the price has really pulled back here. So keep in mind, we are really cheap in natural gas, and we've got a wall of takeaway capacity coming for LNG takeaway capacity in later of 2024, early of 2025. Record natural gas used for electric power generation in the US so far this year. Look at this move for natural gas demand for electric power generation. 2005, it was a little bit over 10, maybe, 12 or something like that. And now we're well over 40. We're probably 45, 46 in terms of this chart here. So we have gone up dramatically over the past 20 years in our natural gas demand for electric power generation. And I think this will continue to move higher. Another thing that I don't know if people realize too is natural gas is very subject to weather, not just cold weather and warm weather. Warm weather for cooling the homes, cold weather for heating the homes. But it's also subject to be the swing producer for weather-related events against solar and wind. So I think the volatility of natural gas going forward is going to get worse and worse with time. We're going to see lower lows and bigger highs, higher highs. And it's going to get really volatile. This thing's going to be an absolute moneymaker at bottoms and an absolute widowmaker at tops. And I'm gonna plan to try to get these bottoms, sell, take some profits at the tops, and play this market as best I can, which is this move back and forth here. And when it's up high, that's when you want to be looking when the prices are down here, because then you get these big moves to the upside. Coming down, update on what happens if I buy gas equities when gas goes below $2. So far, we are rhyming well with history. So what this is, let me make sure you guys can read all of it. There we go. And I gotta really go blew it up pretty good. There we go. Gas hits below $2 per million cubic foot. And we've got days below $2, 59 days, 140 days, 2 days, and 1 day. And right now we're at 14 days so far. So this is how long it stayed below $2 a million cubic foot. 59 days, 140 is a pretty long time. I hope we get something like 60 days, a couple of months or something, because then we can have time to load up. Equity bottom in days, 5, 49, 8, and 0. And then so far we've got 5. Max up day or max UP minus whatever it is, 3-month performance, 6 months performance, and then 12-month performance. If you look at the 6-month and 12-month performance, from this bottom, it was 66% higher from that. 43, 72, and 17 is 3/29/2023, and we're at 10% 3-month performance so far off of the bottom for that. So we could see a big move in a 12-month or 6-month performance going higher in natural gas. And remember, we've got that wall of takeaway capacity coming towards the end of this year. And that's what I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel if you would like. Go to the website. Check out the website if you'd like. We still have the LEAP discount coupon code, LEAP. Get 50% off the first month if you want to try the monthly membership. It's only for the first month. And then you get a larger discount on the yearly membership if you want to go to a yearly membership. All right, that's what I've got for today. We'll catch you later. This is Finding Value.